Guys, this video is a high-level guide on some of the most powerful ICT concepts that we've found extremely effective for consistent trading success. Today we'll break down the meaning, core principles, and proper chart application of each concept to guide you in spotting high-quality trade setups. If that sounds like your thing, don't forget to hit the like button to support us and subscribe to our channel if you're new. Catch you after the intro and disclaimer. Let's begin with the first concept: imbalance, inefficiency, also known as fair value gaps. The SMC trading strategy relies entirely on price action and monitoring institutional behavior, commonly referred to as smart money, directly on the chart. Smart money represents massive order flows executed in the market by banks, hedge funds, brokers, and other large-scale financial institutions with significant capital. How can we recognize smart money activity directly on the price chart? Money by detecting imbalances. Since imbalance, inefficiency, and fair value gaps are closely related concepts. When smart money flows into the market, it disrupts the balance between buyers and sellers, triggering strong price moves marked by large candles and visible gaps between the wicks. In such instances, the price action is labeled sell-side inefficient, and fair value gaps form between the wicks. A fair value gap appears as a three-candlestick formation where the wicks fail to overlap. Here you can see examples of efficient and inefficient prices. In the first example we have a clear bullish fair value gap between the shadows indicating sell-side inefficiency. On the contrary, if you look at the second one you'll notice the wicks meet in the middle, therefore we do not have value gaps and the price is efficient. Now how can we use this to our advantage? When the price moves significantly and leaves fair value gaps behind, it usually returns to these areas to fill the gap and restore balance. These areas become extremely important supply and demand zones, offering potential trading opportunities. In this example, the price is moving in an uptrend. In this area, the price has created fair value gaps indicating buy-side imbalance and sell-side inefficiency. Below the imbalance we can find the demand zone, as this demand zone has contributed to the imbalance. Let's imagine the price creates another pullback and we have another demand zone. The key difference is that the second demand zone has no imbalance, therefore there is a greater chance for the price to make a deep retracement to the demand zone that created the initial imbalance. This is because the inefficiency will act as a magnet for the price to come and fill this gap. So witnessing this scenario on the chart, we will aim for the demand or supply zone that created the imbalance. This zone has a greater chance to reverse the price compared to zones associated with efficient movements. With all being said, the imbalance is a strong SMC signal and one of the first things we spot on the chart. However, just like similar concepts, it needs to be used in combination with other factors to make a well-informed trading decision. The next concept we'll cover is liquidity. Liquidity is fundamentally influenced by the locations of stop-loss placements. Wherever stop losses are placed, liquidity tends to accumulate. Smart money depends on activating stop losses to tactically enter the market, enabling them to secure their positions efficiently. Every swing high and swing low contains liquidity. We know that if the price pulls back to this area, many price action traders will go long and put their stop losses below this level to benefit from the bull market. As price nears the swing high, traders often secure profits or initiate short positions around the resistance level. Thus we have liquidity below the swing lows and above the swing highs. In an ideal uptrend, the correction will happen inside this range and the price will continue pushing upwards once it has gathered enough bullish momentum and liquidity. Many price action traders are observing the chart and looking for a signal to go long. This is why a bullish engulfing candlestick often marks a significant liquidity zone. Many traders interpret it as a bullish signal and enter long trades, placing their stop losses just beneath the engulfing candle. However, as smart money traders, we aim to enter after those stop losses have been triggered. So, if a demand zone exists beneath this candlestick, we wait for price to reach our zone before initiating a buy trade. Liquidity appears in various forms within the market, but we primarily focus on equal highs and equal lows. As the term implies, equal lows occur when multiple low points align at roughly the same level, and likewise, equal highs form when price peaks are positioned at similar levels. What does this indicate in the context of price action? The double or triple bottoms created on the chart are great places to look for trading opportunities for many retail traders. They expect action to the upside once the price taps into this area again, so they enter long positions at these levels and place their stop losses somewhere below this area. A similar pattern unfolds in bearish markets. When price touches a resistance zone, retail traders often enter short positions, anticipating a downward rejection. Their stop losses are typically placed just above this level, leading to a build-up of liquidity in that area. If smart money intends to sell this pair, the setup is ideal to drive the price above the resistance, capture the liquidity, and then shift it back in the original bearish direction. The third concept is the market maker model. What exactly is the market maker model within institutional price movements? There are two main types of liquidity in the market: buy side and sell side. Buy side liquidity exists above a high or a cluster of highs. As price nears this level, bearish traders often enter short positions or safeguard existing ones, while breakout traders may go long if price breaches this zone. The aggressive price movement designed to capture this liquidity is known as buy-side delivery. It pushes price higher to tap into the liquidity above those relative equal highs. This algorithmic move traps traders on both ends, setting the stage for smart money to enter short positions. Now, let's apply the same principle to a bearish context. Liquidity located beneath a low or a cluster of lows is referred to as sell-side liquidity. Similar to the bullish case, as price nears this zone, bullish traders may enter long trades or defend their existing long positions, while breakout traders will short if price breaks below the level. The sharp price movement designed to capture this liquidity is known as sell-side delivery. It targets the liquidity below those lows. This algorithmic move traps traders on both sides, allowing smart money to enter long positions and pursue buy-side liquidity. When price forms support levels and internal structures ahead of reaching a demand zone, the probability of a bounce from that zone increases. This happens because such supports attract buyers, whose stop losses act as sell orders. For smart money to accumulate long positions, selling pressure is required. This setup provides exactly that. The price often reacts at the demand level as buyers capitalize on the perceived value and sellers' orders are absorbed by the buying momentum. With that in mind, spotting liquidity grab patterns within supply or demand zones offers strong confirmation of potential short-term market structure reversals. After these patterns form, the market typically moves in the direction of the nearest liquidity zones. On the other side, market direction, who is in control? Determining the overall market direction is typically the initial step when analyzing a price chart. The goal is to identify the prevailing trend and assess whether buyers or sellers are currently in control. Our strategy always focuses on trading in alignment with the dominant force in the market. How does this system function? It's based on mitigations. When price revisits and mitigates a demand zone, buying pressure tends to outweigh supply, allowing demand to take control. On the flip side, when price revisits and mitigates a supply zone, selling pressure takes over, allowing supply to dominate demand. Picture the market in an uptrend, consistently forming higher highs and higher lows. Every time the structure breaks to the upside accompanied by inefficiency, a new demand zone is established. These zones stay unmitigated until price returns to them, presenting ideal setups to align with the prevailing bullish trend. These demand zones remain untouched until price revisits them, presenting an ideal chance to trade with the prevailing trend. However, if price drops below a confirmed demand zone, it signals a change of character, meaning two things. First, supply has overtaken demand, and second, a legitimate supply zone has been created. Price then begins to decline, forming new supply zones, until it encounters the next unmitigated demand area. At this stage, a tug-of-war emerges between supply and demand, often resulting in consolidation and a ranging market between the two levels. A breakout from either zone reveals which side gains control. In this scenario, we observe 1, 2, and 3 successive moves breaking above previous market structure highs, confirming that demand is currently in control. A previously unmitigated demand zone forms, which is expected to act as support when the price retraces to it. Following a brief correction, the price once again pushes higher with noticeable imbalance, creating another strong demand zone. As long as the price remains above this extreme demand level, the market sentiment remains bullish. However, when the price tests the demand area and fails to generate a new higher high, it signals a potential weakening of buyer momentum. Once the market breaks below the previous low, it confirms that demand is no longer in control. This shift suggests a possible trend reversal. If we mark this point as the origin of the impulsive move that disrupted the bullish market structure, it becomes a valid supply zone and the beginning of a new bearish leg. This marks the origin of our newly established supply zone. As the market continues to break structure to the downside, it confirms that supply is currently in control. During this phase, the price forms multiple supply zones, each presenting potential selling opportunities in alignment with the bearish sentiment. The downtrend persists until price reaches an unmitigated demand zone positioned below. This zone represents a potential area of interest where buyers may attempt to re-enter the market. At this point, a tug-of-war between supply and demand begins, creating a critical juncture. We must closely monitor price action around this level, as it could act as a significant turning point, either leading to a market reversal or a temporary corrective move before continuation of the existing trend. While we cannot control the market, we can control how we prepare for it. By anticipating multiple scenarios and aligning our strategy with the dominant structure, we maintain an edge and respond with confidence, not emotion. Now let's continue with the next topic: order blocks. Order blocks are essentially refined zones of supply and demand, where clusters of buy or sell orders are typically positioned. These price levels have been denied by the market. Once price returns to these levels, it may respond to them again. All order blocks are supply or demand zones, but not all supply and demand areas meet the criteria to be considered order blocks. Let me demonstrate how each reaction to a price level forms a supply or demand zone. It indicates that, for some reason, traders have executed large-scale buy or sell orders, leading to strong price shifts. Therefore, when price returns to these zones, we carefully observe the price action to identify potential trade setups. Still, trading every supply and demand zone isn't practical in the long run. Through analyzing recurring chart behavior, we found that when supply and demand zones meet specific criteria, the likelihood of a successful trade improves significantly. One of the most reliable supply and demand structures is the order block. So first, let's explore what factors make a zone a valid order block for trading, and then I'll walk you through how to accurately identify them on the chart. Criteria for a valid order block. The first and second requirements are the presence of inefficiency and liquidity grab, which we covered earlier in the video. The third requirement for confirming a valid order block is a break in market structure. In a bullish setup, when a price swing breaks the most recent market structure and closes above the previous high, the starting point of that move gains major significance. It indicates that the demand zone driving this move is not just any level, but a key area within the market structure. With that in mind, a supply or demand zone qualifies as a valid order block if it results in a structural break. The same concept applies to the bearish scenario when a price movement breaks the latest market structure to the downside